What are people asking you right now about this?
You know, I think one of the major things that people are asking about is the divergence between equity volatility and other asset class volatility. Particularly when we look at equities last year versus this year. Last year we were in a situation where people were worried about rate volatility, people were worried about FX volatility, and people were persistently talking about the fact that equity volatility is so low. If we look at VIX prints under 10, we had a record number of those prints under the level of 10. Now, this year we have almost the exact opposite, which is the fact that FX and rate vol is subdued, but equity vol is elevated. And what we really haven't seen is a spillover to other asset classes.
So we happen to have a chart to illustrate exactly that point. If you take a look at this part, this is actually volatility in debt, in FX, and in equities. And you see over here on the right, they all spiked up in early February. And then since then, it's come down actually quite a bit in both FX and debt, while the volatility in stocks has stayed right up there. So really the two markets have diverged.
And I think that's partially a matter of, if you think about vol, it tends to be auto-realizing, as in, if it's low, it remains low. If it's high, it remains high. And particularly in the equity sector, at least, central banks have come in time and time again. Look at, let's say January and February of 2016, when the market collapsed, the Fed became more dovish, EM rallied, and people got back into the market and became bullish. But now we're toward later in the cycle. Equities are a bit more dubious. Earnings expectations have a higher margin of error around them. So other things potentially may revert faster than equities.
Well, that's one of my questions. What causes this? I mean, on the one hand, is it because we think that equities may be really highly valued, so we're not quite as sure of them, and that causes more volatility? On the other hand, you'd expect FX particularly to react to the possibility of a trade war, because it tends to react to geopolitics.
Well, I would say as far as the trade war, it's really interesting because the amount of uncertainty around the potential outcomes, whether it's an all-out trade war, a negotiated settlement, is so high that I don't think people can really price it in at the time. But with equities, at least, people have been complaining. Investors, financial press, et cetera, have been complaining about the stretched valuations, but have justified them on the basis of two things. One, the fact that vol was so low, and two, the fact that rates were so low, and there really was no alternative to invest. So now that you have both of those conditions out of the way, it makes the equity market a bit more dubious.